The US stock market is one of the single greatest wealth generators in all of human history. Behind me on this board, I'm going to show you two different ways that people for over 100 years have been getting rich with stocks. So in this video, we're going to focus on growth stocks versus dividend stocks. And we'll go through the differences and which is better in certain situations or which is best overall. So by the time we get to the end of the video, you'll have a really good idea of which type of investing is best. So first of all, let's define what is a growth stock and what is a dividend stock. Well, in its most simple form, a growth stock is all about capital appreciation, right? So capital appreciation would be you buy a growth stock at $100 a share, okay? The capital, right, your money appreciates, that share of stock appreciates in value, whether positive news came out, the company is doing well, earnings increase, whatever it may be, the share of that stock price goes up to 150. So you sell that stock on the open market to another investor, okay? And so you bought it for $100, you sell it for $150, you make $50. So you're speculating that when you buy a growth stock, you're going to sell it to someone in the future for a higher price. That's why I have speculation. Now, that's not bad. Any investment, you're going to find a little bit of speculation, but primarily with growth stocks, that's what you're doing. You're saying, I'm buying this stock, right? I have confidence in the product, the process, the people, the management, the market, whatever it may be. I'm buying this stock and I'm speculating that I'm going to be able to sell it in the future at a higher price, okay? So that's essentially, in its most simple form, what a growth stock is. Now, a dividend stock is a little bit different. Dividend stocks focus on current income, not so much capital appreciation, but current income. What does that mean? Well, cash flow, right? With that, an investor is collecting cash flow, right, while having his or her money at risk. Same thing, the share of the stock can go up and down, but primarily people invest in dividend stocks for current income. So that's really the main differences between those both. Now, long-term time horizons are usually better for growth stocks because growth stocks are highly volatile, meaning the share price is going to go up and down and up and down, but generally history shows us the broad growth funds and ETFs trend in an upwards trend line. So while they're going up and down, they're going up in they're trending upwards. So long-term time horizon is best for these types of stocks because you really need to give it the time to be able to go up and down in that upward trend line, hopefully, right? Some of them go down forever. Long-term or short-term horizon doesn't matter with dividend stocks so much because they're fairly stable. Now, obviously, they still fluctuate, some of them violently, right? But overall, dividend stocks are less volatile. They'll fluctuate less, so they're relatively stable and they're suitable for either long-term investing or short-term, right? So that's the difference there. Now, with growth investing, you're subject to unrealized gains or losses, right? So let's say you invest $1,000 and you need the money in 15 years. Well, over the course of 15 years, that $1,000 has grown to $5,000, okay? And you're getting ready to cash out, you're happy, and then you have a market crash to where your $5,000 investment goes back down to $1,000. So you've essentially gained nothing from patiently waiting for 15 years for your growth stock to bring home the bacon. So unrealized gains and loss, and you'll notice that on your statement, unrealized means, if your investment goes up by 100%, that's great, but you haven't realized that money until you sell and lock in that gain, right? So a lot of volatility there. Now, with dividend stocks, you're able to harvest cash. So if you buy $1,000 worth of a dividend stock, the price goes up, the price goes down. Well, yeah, it's not good that the price goes down, but you're still harvesting cash. So at least over the course of 10 or 15 years, if the company fails, at least you've harvested that cash quarterly over those 15 years. So that's another major difference. And the reason why growth stocks don't pay dividends is because they're reinvesting their earnings that they would pay a dividend out of. They're reinvesting all their profits and money to expand their business operations because they're still developing and marketing new products and really expanding their footprint, whereas dividend stocks are established and really focused on existing operations. Now, that doesn't mean that all dividend stocks don't grow or they're still not growing, but at least they're to a point where they can take some of their money, some of their earnings, and pay it out in the form of a dividend to shareholders. So for a good example of this is Amazon, right? Amazon has only been around, 25, 30 years, so to speak. So they're still growing and innovating, growing across the globe. Whereas a good example of a dividend stock is Coca-Cola. They've really reached every corner of the world. I remember when I was in Afghanistan, in the Marines, we were in some of the most remote parts of the desert in Afghanistan on the Pakistan-Afghan border, and roll into villages and markets that didn't have paved roads, they didn't have electricity, utilities, very basic living, but they had Coca-Cola for sale, right? So Coca-Cola has really pushed its products in every corner of the globe. So they're large and established. So primarily they're focusing on their existing operations, little acquisitions and things like that, but they're, and at the same time though, they're rewarding their shareholders with some of that cash. So what is the better investment long term? Well, let's take a look at the returns from 1930 to 2017. 42% of the S&P 500 returns have come from dividends, whereas 58% of the S&P 500 returns during that time period have come from growth stocks. Now, it hasn't been an even across the board, a consistent 58 and a consistent 42 for all of history. In fact, what I'll put up on the screen right now shows that in a really, really good example. So, for instance, like in the 1970s, that entire decade, and the 2000s, the lost decade, dividends really, really carried your portfolio, right? And essentially almost all of the returns came from dividends. Whereas bull markets like the 1990s, 1950s, 1980s, primarily the winners were growth stocks. So as you can see, different markets favor different types of investing. So for growth stocks, the highest returns, and I'll put this up on the screen, the highest returns are usually small cap growth. So for instance, here on the screen here, we have small cap stocks are really the winner over a long period of time. Second place is large cap stocks. Third place, government bonds, gold, real estate. You get the idea. And then another very interesting chart that I'd like to put on screen is called an index chart. Now this is a very interesting chart, and maybe in another video we'll go through it in more depth. So what you'll notice on the left-hand side of the index chart, the very left, is $1 invested in 1926 all the way to the end of 2018, and we're in at 32,645, 11.8%. And this is the U.S. small stock total return. So there's some dividends in there as well, but primarily small cap companies are growth companies for the most part. And so you can see U.S. large stock total return is just under that. And then the yellow is a balanced portfolio. So as you can see, different types of time horizons, risk tolerance, different goals really call for different types of investing. So small cap growth stocks in general are really best to buy after a correction or after a crash when there's blood in the streets, because these types of stocks are the most volatile. So when times are good, they're flying. When times are bad, they're dropping like a rock. So if you can pick these up really cheap, that's always a good time to buy, is after a correction or a crash. On the flip side of the coin, dividend stocks, and the highest returns for dividend stocks are dividend aristocrats, right? ETFs like Noble, you can own the entire group of them. But the best time, these are best to hold through corrections and through crashes because they're a lot less volatile and they're also providing income out during those times. So which is the best stock? Well, that's really a loaded question. And as you can see, as the math shows and the historical data shows, it's really best to have a mix of both. When you have pure growth investors out there saying, no, the growth is the only way to go, it's not really the most educated statement someone can make. Same thing on the dividend side. If you have someone that says, I only buy dividend stocks, I only invest in dividends, it's not really the smartest move, in my opinion, looking at the data long term. So hopefully with that being said, you learned the major differences between growth stocks and dividend stocks, as well as the different mechanics of them, how they work, when the best time to buy them, and really what the best mix, and that's both of them, really is. So with that being said, thank you so much for watching. I look forward to seeing you guys in the next video. But wait, don't stop here. Check out these two videos. Click on one. I think you'll like it.